Picture this. You're advising an Indian manufacturing company that regularly buys raw materials from its foreign parent company. Sounds pretty standard, right? But under our newly modernized tax code, do you know exactly what triggers the transfer pricing rules for this setup? Welcome to This Explainer. Today, we're diving deep into the Income Tax Act 2025, specifically Section 163, which tackles the meaning of an international transaction. If you're a chartered accountant, a tax pro, or business owner dealing with cross-border operations, getting a handle on this provision is an absolute must-have for your compliance toolkit. We've got a really solid roadmap for today. We'll start with a quick introduction to Section 163, decode the actual legal provision, walk through a highly practical case study, look at key compliance requirements under the new rules, highlight some common practical issues, and wrap it all up with a concise summary. Let's get right to it. So, going back to that opening scenario, what actually happens when an Indian company transacts with its foreign parent under the 2025 Act? How do we know for absolutely sure that this falls under the transfer pricing scanner? Well, to figure that out, we need to look at how the framework has evolved. Which brings us to our first section, a brief introduction to Section 163. For decades, tax professionals relied heavily on Section 92B of the old Income Tax Act 1961 to identify international transactions. But now, as the CBTT's transition FAQs clearly point out, the 2025 Act is all about consolidating and simplifying things. Those legacy provisions, they've been seamlessly transitioned into the much more streamlined Section 163. It modernizes the language, but crucially, it does this without unsettling all those established tax positions and precedents we're used to. Okay, so what is the actual precise meaning under the new act? Well, the core definition remains super strict. For a transaction to be classified as an international transaction under Section 163, two uncompromisable conditions have to be met. First, the transaction has to be between two or more associated enterprises, or AEs. Second, and this is the absolutely crucial point, at least one of those enterprises is necessarily a non-resident. If both are residents, Section 163 just doesn't apply. Let's decode this legal provision a bit further to see exactly what kind of transactions are covered. The law casts a genuinely wide net here. Clause A explicitly covers the purchase, sale, or lease of physical, tangible assets. We're talking everything from buildings to machinery to vehicles. But then Clause B brings in intangible property. And honestly, if you're valuing intellectual property transfers, this is exactly where your focus needs to be. It covers patents, copyrights, trademarks, customer lists, franchises, commercial secrets, you name it. Basically, if any kind of value is crossing borders between associated enterprises, it's captured here. Now, let's look at a practical case study to really cement this idea. To clearly illustrate how this plays out in the real world, check out these two scenarios. First, we have Entity A, a resident Indian company transacting with Entity B, its foreign associated enterprise. Because Entity B is a non-resident, boom, the verdict is crystal clear. This is an international transaction under Section 163. But now consider the second scenario. Entity A transacts with Entity C. Entity C is also a resident Indian company, even though they are associated enterprises. The verdict here? Not an international transaction under Section 163. Why? Because it completely lacks that strict non-resident requirement. Other specified domestic transaction rules might apply elsewhere, sure, but it completely escapes Section 163.
All right, moving on to Section 4, Key Compliance Requirements.
Look, understanding the law is just step one, right? Ensuring strict procedural compliance is where the real heavy lifting begins. Under the newly notified Income Tax Rules 2026, compliance is sharply codified. If your client triggers Section 163, you've got to meticulously maintain the prescribed transfer pricing documentation that's mandated by Section 171 of the Act, read with Rule 89. On top of that, taxpayers absolutely must furnish the mandatory accountant's report, which is now governed by Section 172 and Rule 90. You also really need to familiarize yourself with the new reporting forms. For instance, if you're dealing with an advanced pricing agreement under Section 168, you're going to use Form 46 now. That totally replaces the old Form 3 CED. And if you're exercising the option for determining the arm's length price under Section 166.9, you'll use Form 46. Using these updated forms is, frankly, non-negotiable if you want to avoid instant system rejections on the new e-filing portal.
Let's quickly touch on some common practical issues we're seeing.
Transitioning between statutory frameworks almost always leads to some practical hiccups, and a really common compliance mistake we're noticing is the reliance on outdated terminology. As heavily emphasized in the CBDT guidance notes, the 2025 Act universally drops that old, confusing duality of assessment year and financial year. Instead, it adopts a single, unified global term, tax year. You're going to see tax year across all new reporting formats, including your transfer pricing documentation and those accountants' reports. Getting this simple terminology wrong can actually lead to serious filing errors, so definitely watch out for that. Which brings us to our final section, the summary and key takeaways.
We've covered a ton of ground today. To quickly recap, first, Section 163 is the modern equivalent of the old Section 92B. Second, to be triggered, it strictly requires that at least one of the transacting associated enterprises is a non-resident. Third, its scope is massive, capturing the transfer of both tangible and intangible assets. And finally, robust compliance means you absolutely must maintain your documentation under Rule 89 and file that accountant's report under Rule 90 of the Income Tax Rules 2026.
So here's a final thought to leave you with. As tax authorities increasingly leverage AI and advanced data analytics on these new Form 46 and 54 filings, the question isn't just whether you filed the right form anymore. It's whether your arm's-length pricing strategy can withstand instantaneous automated scrutiny. Are your transfer pricing studies truly ready for the 2026 digital audit trail? Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.